For the entire time you have been building your retirement savings, every year of contribution, every year of compounding, every annual statement showing a number growing in a way that reflected real discipline and real patience, there has been a silent partner in the account. This partner contributed nothing. They took no risk during the market downturns that erased months of gains before eventually recovering. They made no decisions about what to hold, exercised no judgment about when to rebalance, performed no analysis of any investment. They sent no correspondence and attended no meetings, and yet they hold a legally binding claim on a meaningful percentage of every dollar in your tax-deferred retirement accounts, a claim that has been accumulating invisibly alongside your own balance, and that will be settled transaction by transaction, across every year of distributions that your retirement produces. The silent partner is the tax authority. The claim is the deferred ordinary income tax that was never paid on your contributions during the working years and was never paid on the compounding growth those contributions generated. And the single most important revelation I want to offer today is that the size of this claim, the exact fraction of your lifetime retirement distributions that flows to the silent partner rather than to your life, is not fixed by anything that happened during accumulation. It is determined entirely by how deliberately you structure the distribution phase. My name is William Grant. What I want to develop carefully today is not a list of techniques or a catalog of available instruments. It is a single organizing idea, stated with enough precision that it actually produces decisions rather than merely producing interest. The idea is this: most people over 50 treat the tax cost of retirement income as a fixed and inevitable quantity determined by the tax code and outside their meaningful control. This is wrong. The tax cost of retirement income over a 20 or 25-year distribution horizon is profoundly responsive to specific decisions about how that income is structured each year. Decisions that exist, are available, and that, made at the right time, in the right sequence, permanently reduce the silent partner's share. Decisions that most people have never made because no one has surfaced them as decisions, and because the window during which they produce their maximum benefit has a specific and irreversible closing date that most people are not tracking. The mechanism that makes the silent partner's share a variable rather than a constant is something I want to explain at the level of a single year's distributions, because this is where its controllability becomes visible. When you take a withdrawal from a traditional tax-deferred retirement account in retirement, that withdrawal is added to every other dollar of income you receive in that same year. Social Security benefits, pension income, interest and dividends from taxable investments, consulting or part-time income, any rental income, and the resulting total determines your marginal bracket and your effective rate for that year. The silent partner takes their portion at whatever rate the combined income picture produces. If the total picture is modest, because your income sources are few and your discretionary withdrawals are calibrated, the rate is modest. If the total picture is elevated, because required minimum distributions are large, because Social Security is running, because a pension is added on top, the rate applied to the same IRA withdrawal is higher, even though the withdrawal itself is identical in both scenarios. The silent partner's share of each dollar you receive is not determined by that dollar alone. It is determined by everything else happening in your financial life at the same moment it arrives. This is why the structure of retirement income is a planning variable rather than an accounting constant. The sequence, timing, and coordination of how different income sources activate and interact each year determines the annual tax picture. The annual tax picture, repeated and accumulated across a full retirement, determines the silent partner's aggregate claim on your lifetime distributions. Change the sequence and coordination, and you change the claim. The claim is not negotiable in any individual year. You pay what the tax code says at the bracket your total income occupies. But the total income your position occupies each year is the product of decisions that were made or not made years before the year of distribution arrived. I want to make this concrete through someone I worked with named Evangeline. She was 63 when we first sat together, a retired pharmaceutical research scientist with 31 years of career in drug development. Someone whose professional life had required sustained rigor in distinguishing what data appeared to show from what it actually demonstrated in a complete biological system. Analytically, Evangeline was among the most methodical people I have encountered in 4 decades of practice. Her traditional IRA, built through maximum contributions across 31 years of senior-level compensation, held a balance representing a figure larger than she had earned in any 10 consecutive years of her career. She had a taxable brokerage account holding positions with significant embedded capital gains she had never realized. She had a small Roth IRA from early in her career, modestly funded and largely ignored in subsequent planning. She had not yet claimed Social Security, planning to do so at full retirement age, and she had a life expectancy that her health history and family profile suggested extended comfortably into her mid-80s. When we mapped her situation under what I call the default path, taking IRA distributions as needed for living expenses, claiming Social Security at full retirement age, selling taxable positions when liquidity required, without reference to the tax position being created by the sale, the silent partner's aggregate share across the following 23 years was a figure she had never previously computed and had never seen on any account statement. Required minimum distributions beginning at 73 would be large enough that when combined with Social Security income, already running at that point, and with investment income from the taxable account, the total annual income in those years would occupy brackets she had not occupied since her peak earning years as a working scientist. The effective rate applied to her distributions in those years would be meaningfully higher than the rate available in the transitional years she was currently living through, the years between her retirement and the onset of mandatory distributions, during which her total income was at its lowest point since before her career reached seniority. This asymmetry is the window. The transitional years, between retirement and the commencement of required minimum distributions, represent a specific and finite interval during which the conditions for certain decisions are more favorable than they have ever been or will ever be again in a person's financial life. During this interval, income is low. Bracket space that was unavailable during peak earning years and will be unavailable once mandatory distributions arrive is genuinely available now. The question, which most people never ask because no one surfaces it as a question, is what can be done within this interval, at these temporarily favorable rates, that permanently improves the position after the interval closes. For Evangeline, the primary answer was systematic Roth conversion. By converting a carefully calibrated annual amount from the traditional IRA to the Roth during the transitional years, paying ordinary income tax on each converted amount at the rates available during this specific low-income window, she permanently removed those dollars from the required minimum distribution calculation and permanently converted them from future taxable withdrawals to future tax-free income. Each converted dollar was a purchase of permanent tax-free status at a discount available only during the transition. Once distributions began and Social Security was running simultaneously, the bracket space that made the conversions efficient would be gone. The conversions would still be nominally available, but practically inefficient, because every converted dollar would now be taxed at a marginal rate elevated by the other income that transition had ended. The Social Security timing decision amplified the same logic. Claiming at full retirement age versus waiting until 70 represented a permanent reduction in monthly benefit of approximately 31%. Over a life expectancy extending into her mid-80s, the actuarial break-even favored waiting with meaningful clarity. The tax dimension reinforced the delay. A higher monthly benefit at 70 would cover a greater share of Evangeline's annual income need from a source taxed at a lower effective rate than equivalent IRA withdrawals, meaning less of her living expenses each year would require drawing from the fully ordinary income taxed account. The Social Security timing decision was not separable from the broader tax architecture question. It was one of its primary levers. The embedded capital gains in the taxable account were coordinated into the same window. Rather than allowing realizations to occur when liquidity needed them, adding gains to whatever income happened to exist in that year, the realizations were planned for years within the transitional window when total income was lowest and capital gains rates applied at the most favorable levels available. The same gain, realized in a transitional year versus a year of mandatory distributions and active Social Security, carried a meaningfully different tax cost. The gain was the same. The system it entered was different, and the system determines the cost. The combined effect of Roth conversions, delayed Social Security claiming, and coordinated gain realization, executed systematically over a multi-year window before the transitional period closed, permanently restructured the distribution of Evangeline's accumulated wealth between her financial life and the silent partner's claim. Not by changing a single dollar of what she had accumulated, by changing the sequence and timing of how that accumulation entered the tax system, year by year across the distribution horizon. At our final planning session, Evangeline described the experience in terms I have carried since. She said her career had been organized around understanding biological systems, learning how each component interacted with every other to produce emergent properties that no single component predicted in isolation. She had never mapped her retirement income as a system. Once she did, what she found was that the silent partner's share was a system property, not a fixed feature of any individual account, but an emergent product of how all the accounts and income sources were configured relative to each other across time. Reconfigure the system, and the property changed. The reconfiguration was available. The window for doing it efficiently was open, and the window had a closing date that could be calculated precisely from information she already had. That is what I want to leave you with. Not anxiety about what may have been missed. The specific question of whether your window is open, how long it remains open, and whether the decisions available within it make sense for your situation. The year when your required minimum distributions begin is a number you can find today on a government website with your date of birth and your account type. The number of years between today and that year is your window length. Write it down, then ask, honestly, whether any deliberate decision has been made in the context of that window. If the answer is no, and for most people the honest answer is no, you have just identified the most important financial planning conversation available to you before that number reaches zero.